A new inflation report just surprised Wall Street by showing prices coming down, and markets reacted. Stocks rallied, and rate cut bets got louder. But here's the part most retail investors aren't hearing. Many economists are warning that the data might be flawed, and that could matter a lot for your portfolio decisions. Why the skepticism? The government delayed the release of the latest CPI report, and when it finally came out, it showed inflation slowing more than expected. That sounds great at face value. Lower inflation could mean cheaper money and higher stock valuations, but economists are pointing to quirks in the reporting methods, timing shifts, and statistical adjustments that might be distorting the real picture of price pressure in the economy. If the inflation decline is overstated due to timing or technical issues, and prices aren't actually cooling as much as the headline suggests, then the Federal Reserve's policy outlook could be very different from what markets are pricing in. In other words, investors could be prematurely celebrating rate cuts that may not happen, or at least not as aggressively as expected. For retail investors, this matters because market expectations drive valuations. Growth stocks and long-duration assets rally when traders bet on looser monetary policy. But if inflation sticks higher than the headline says, interest rates could stay elevated, and that's often bearish for high multiple stocks. The takeaway is simple. Don't take one report at face value, especially when big institutions are signaling doubts. Look deeper at underlying price trends, listen to multiple data sources, and don't pivot your investment strategy solely on one potentially distorted data point. In short, markets may be reacting to a mirage, not reality. Stay disciplined, stay informed, and base your decisions on trends, not headlines.